Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. The recent decline in the market has given investors a lot of opportunities to buy stocks that were formerly extremely expensive. And in particular, today I wanted to dig into 3 growth stocks that I think are now starting to look like fairly attractive values. They may be facing some near-term challenges with their growth rates or with margins, but long-term, these are the kind of companies that I want to have in my portfolio and just allow them to grow into the maturing companies that they are. So the 3 companies I'm going to highlight today are Topgolf Callaway, Lululemon, and Yeti. These stocks are off 47%, 37%, and 64% respectively from their all-time highs. So a lot cheaper than they used to be. Not necessarily value stocks. I wouldn't put them in that category. They're still growth stocks, but a lot to like here. So let's dig into it. My name is Travis Hoium. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my coverage, particularly on disruptive companies. And these are the kind of companies that are disrupting the markets that they're in today. I want to just start with a high-level look at these 3 companies and the growth rate that they've had. Because you can see from this chart here that these 3 companies have all more than doubled their revenue over the last 5 years. Topgolf Callaway is in a little bit of a unique position here because it did acquire the Topgolf brand. That's where a lot of that growth you see here is coming from, but is really growing across the business. So that's why these companies popped up to me, is that they're still growing companies and they're starting to be pretty attractive. So let's start digging in with Topgolf Callaway. These are the high-level numbers. This purple line here is revenue on a trailing 12-month basis. You can see they're doing about $4 billion in revenue right now. This is a company with a market cap of $3.8 billion. So price to sales multiple is under 1 at this point. Net income and improving margins. Now, net income right there, clearly been impacted by the pandemic. We're still having some recovery from that and getting back to a little bit more of a normal level. But the thing I want to highlight with their business, particularly on the Topgolf side of things, which is where I think the growth is going to be, is that their cash on cash returns on the locations that they're building are about 50%. And that goes back a number of years. So they have a pretty good feeling for where they can build locations, how profitable they're going to be. I think this experiential business is going to continue to grow and be a bigger and bigger piece of the economic pie. And as there is a bigger chunk of the workforce that's going to be working from home, we're going to have to do things out with coworkers and with friends. Topgolf is the kind of location that I think is going to have tailwinds as a result. So that's why I really like this business. The golf business, the traditional golf business, is not actually a business I would like to own at all. It's the Topgolf business that I think is really great. So investors are starting to get some pretty good value here. You can see this table, there's a lot of information here, but the market cap is the green line here. You can see it's come down quite significantly from its peak in 2021. And the price to earnings multiple is now only about 26. So that's not a cheap stock. Like I said, these aren't value stocks, but given the rate that it's growing and the returns that Topgolf has, I think this is a fair price to pay for the stock. And that's why it's actually been one of my most recent purchases, is Topgolf Callaway. So put that one on your radar if you don't already have it on there. And the next one I want to dig into is Lululemon Athletica. This chart here shows revenue in the purple line, net income in the orange line, and gross profit margin on a quarterly basis with the blue line. The reason I put gross margins in there is I want to see, is that something that is trending upward or downward over time? You can see there's generally a upward trend, but the thing that I like here is that there's not a lot of volatility in the last few quarters as we've gone back to more of a normal economic environment. And surprisingly, this is not a company that was heavily impacted by the pandemic on the revenue side either. The net income piece is what I think is the most fascinating for Lululemon. Net income is just steadily growing and growing over time. This is exactly what you want to see from a clothing brand, from an apparel company. They should have a lot of operating leverage because they're able to leverage both the locations that they have and then the designs and the branding that they're doing, the operating spend that they have there. And as the business grows, that net income should grow at a faster pace than revenue. This final chart here, again, a lot of information here, but PE ratio is about 34. The market cap is nearly $40 billion. Net income has nearly doubled since just before the pandemic. So this is maybe a little bit more expensive stock than a company like Topgolf Callaway. But given those growth numbers and the brand recognition that they have, I still think this is a really well-positioned company. Maybe worth a starter position. Maybe don't go all in on Lululemon right now. But if the stock does pull back, I really like where they're headed right now. Yeti is another one that has been on my radar for a long time, but has always been very expensive. Great brand, products that I use all the time. My kids use them. The challenge has always been, how much do you pay for a stock that's making a consumer good, might be it albeit a high margin consumer good, but still this is typically a very volatile piece of the market. So don't want to pay too much for a stock like this. But right now it's getting to be pretty attractive. Like I said early on, the stock has really been hit hard. And you can see from this chart here that revenue has more than doubled over the last 5 years. The company is generating positive net income, positive cash flow from operations. So given this is a growth company, that's a positive sign for Yeti. Earnings are starting to pull back a little bit over the last couple of quarters. And this would be a company that is being impacted a little bit more by more of a going back to normal spending patterns after the pandemic is ending. So retailers are starting to reconfigure their inventory. People are maybe buying fewer things for outdoors, at least on a short-term basis. But if you think about the long-term trajectory, this is a really well-positioned company, and the near-term operational challenges, I think, are going to be short-term in nature. So maybe this impacts Yeti over the next few quarters, maybe even year or two. But long-term, this is the kind of brand that I want to get into. And here's the company's net income. You can see just trending higher over the last 5 years. And that market cap number has now come down to basically where it was pre-pandemic. So this is a much bigger, much better operation than it was before the pandemic. But we're essentially getting a pre-pandemic price for the company. And that puts the price to earnings multiple currently at about 38. But like I said, net income has been negatively impacted over the last couple of quarters. If you go back to on a normalized basis, basically when some of these one-time trends aren't going on, it looks like the price to earnings multiple is more like in that 15 to 20 range. So given the quality of this business, the quality of the brand, the growth that Yeti has, I think that's a really reasonable multiple to pay. What I'm looking for over the next few quarters is, are they able to keep operating costs under control? What does revenue growth look like? And then what do margins look like? During the pandemic, it did seem like there was a pull through of demand. So are they able to get back to a more normal gross margin pattern? I think they will. I think that ultimately this will be a real valuable time to buy the company, but those are the things to keep in mind. So three growth stocks that may be priced a little bit more attractive than they've been in a very long time: Topgolf Callaway, Lululemon, and Yeti. What do you think about these three stocks? I'd love to hear your comments in the comments section below. Follow Rive Investing here on YouTube for all of my content. Thank you for watching, and I'll see you here again next time.